Yo, what's good, guys? Welcome back to another trading video. Today's video, I'm going to be teaching you guys how to spot liquidity, market structure shifts, and fair value gaps. What drawn liquidity means, what a market structure shift means, what a break of structure means, what a fair value gap means, and potentially what an order block means as well. Now, some of you guys hit me up and have been, we've been chatting with some of you guys, and people have been, finding it difficult to find what market structure shifts are and what liquidity is. So I'm going to do a step-by-step, and this applies to every one of my strategies. And these confluences come, and they can be used with any strategy whatsoever. Any strategy, no matter what strategy you guys trade. It doesn't have to be from ICT. It doesn't have to be from whoever. You can implement this even if you trade supply and demand. But these are three key points or three key confirmations I look for, which is draw on liquidity, market structure shift, and fair value gap. So I'm gonna go ahead and show you guys I'm gonna show you guys drawings first, then I'm gonna show you guys examples on the chart. So first off, liquidity. We know that price moves in either a bullish market or a bearish market. Bullish simply means price is making higher highs and higher lows. So it's like, it's going up. This is what bullish means. Bearish is when price goes down and makes lower lows and lower highs. Okay, so this is what bullish means, and this is what bearish means. Bearish means down, bullish means up. Now that we got that out of the way, every trend has liquidity. So when we're going on a bullish trend, the top up here is simply liquidity. There's liquidity resting up here. Okay? Now, if price were to come up again, right? Starting from here, and it goes up. What do you guys think price did? Price made a double top because it tapped its previous liquidity. It didn't make a higher high. It chased liquidity, then came back down again. So every time price goes up, we're always going to look for sells. Every time price goes down, like this, we're always going to look for buys. Because once price chases back down to the liquidity, the sell side liquidity, we're going to look for a market structure shift and a fair value gap. That way, price can continue going up, and then eventually this will be called liquidity. Okay, this will be called liquidity. I'm just gonna draw it out for you guys real quick. Okay, so this exact diagram shows exactly how trading works in the trading world. So liquidity is resting up top here. We know that. Liquidity is resting up here. Liquidity is resting up here. And liquidity is resting up here. Okay? And so is here. I'm just going to draw one line so that it matches up. It's the same line. Okay. We know that price first created a lower low. Okay? Then price came down to create a relative equal low. So it's relatively equal. It's not exactly on the line. Sometimes it could be exactly on the line. Sometimes it could be a little bit under the line, just by 1 or 2 pips. Maybe above it 1 or 2 pips, which is the scenario right here. This is what draw on liquidity looks like. Liquidity attracts like a magnet, right? So liquidity simply means price had money lying up top of every buy side liquidity. Every sell side liquidity, there was no money, and people set their stop losses under that low. Okay, people now don't get me wrong, people do set stop losses either or. Like if I enter here, I'll put my stop loss. I'll put my stop loss like here, and then this is still called, like this would still be considered, sell side liquidity, and vice versa. This would be buy side liquidity over here. Top. Why I don't know why it's spawning like that, but this is still where the red is still buy side liquidity. So people place their stops up here. But in the market, in the general market, because not everyone trades leverage, for example, on the US, NASDAQ, not everybody trades leveraged NASDAQ. Everyone, like not everyone, but most people trade stocks, like the NASDAQ stocks, and the institutions and the investors and other hundreds of thousands of investors in the world who invest in NASDAQ as an actual index fund don't day trade, meaning their money is it's resting up top. Their money is resting up top, so when they pull money out of the market, it drops. That's why price chases back to stop those traders who didn't pull out their money and to make them lose once the new traders set down their sell positions. Once they pulled their money out and went for a short position, the market institutions wants to stop out both people who didn't pull their money out and people who did reinvest up top here. So sometimes, or usually almost all the time, price would come up and stop these traders out. That is the most advanced way I can explain to you guys on how liquidity works. Now, I drew a market structure shift as well. So market structure shifts is a displacement and trend, a change of direction in the trend in the market, right? It's a change of direction. So let's say we just discussed what bullish and bearish means. So let's say price is at the moment bearish, right? It's bearish. It made a low. It made a lower high because every bearish market makes lower lows and lower highs. Every bullish market makes higher highs and higher lows. So this made a lower high. But then right after, as you can see, we spoke about liquidity. Price didn't make a lower leg. A leg down, it did not make a single lower. It didn't sweep the previous low. Okay? Meaning, we're going to sit there and wait patiently until price breaks through this small liquidity point or market structure point, right? And then we're going to look for a fair value gap. So as you can see here, price clearly broke over the market structure, making it a market structure shift. After every single market structure shift that happens, anytime you're trading, you're always going to have a fair value gap, whether or not you wait for later it happens at the time of the market structure shift or way before. You're going to wait for a retracement. A retracement, you don't have to be a day trader to know what retracement is. Retracement happens in the crypto market, stock market, index market, forex market, whatever you're trading. A retracement is just price coming back down to fill orders previously and to continue going back up. Institutions usually fill that gap. The manipulation in the market fills that gap, right? So a fair value gap is just three consecutive candles, either bullish or bearish, that cause a gap between those three candles. The one in the middle would be called or considered the gap without any wicks interfering between that gap. So marking it out would look something like this after the fair value, after the market structure shift. Fair value gap would look something like this. Once price gets into it, it continues going up, sweeping old highs, old buy side liquidity. It's a draw on liquidity. So it keeps going up, and forms a new buy side liquidity, which then now price has to reach up here eventually, which it did later on. But before price can reach over here again, up here, it has to reach the lows, the old lows, which this was a low down here. So price went leg down, leg up, leg down. It ran this liquidity out, made a market structure shift, but then this was a draw on liquidity. So price had to continue going up, and you can find a fair value gap somewhere in here, that would tap it in later on. Okay? The market doesn't always respect fair value gaps, so don't get me wrong. It doesn't always work. Fair value gaps don't always work. That's why there's something called an inverse fair value gap, which I will discuss in the next video. But for now, I'm going to show you guys exactly how everything looks like on the charts, because it is really confusing at the moment for everyone who's watching. So let me do that right now. All right, everyone. So here is an example of how it would look like on the charts. Okay, so we're going to first mark out, as we spoke about, liquidity levels. So we're going to mark out buy side liquidity and sell side liquidity. So sell side liquidity is the absolute lowest point of the trend. So I would mark out the lowest point I could find and just drag it out until I see some place where price ran out that liquidity. It drew on it, it continued going downwards, and it broke past the old liquidity point, which was down here. Now, it could have been over here, it could have been over here, it could have been over here, but it happened over here, meaning we're going to draw it out. We're just back testing right now, right? We're going to mark out buy side liquidity, which is all the way at the top here, and just drag it out. Okay? This is buy side liquidity. Now, what did the price then do? Okay? Price, when it ran out liquidity on the bottom, over here on the bottom, it started forming lower high, then a failure to create a lower low. So lower low, lower high, a failure to create a lower low. Price continued to make break of structure until it broke above this market structure shift. It made a market structure shift. This candle, this blue candle over here, closed above this consolidation block or market structure barrier and allowed price to continue going forward in the same direction. Remember, we spoke about fair value gaps that form with, behind, or after a market structure shift. In this case, it formed right at the candle that broke it. Okay? Now, I'm going to show you guys exactly how to mark out fair value gaps. So let me here. So you guys see this gap over here, right? You see how there's no wick involved between this gap over here, between this black candle and this blue candle? So this bullish candle and this bearish candle, 1, 2, 3 candles, there's a gap in between those 3 candles. So for a bullish trend, you're going to mark out the top of the first candle and the bottom of the third candle. That includes the wick. If there's no wick, it's the candle close, the candle's body. You're not going to override the candle. You're going to make sure it's right resting where the candle closed. Then you're going to drag it out and wait till price taps in to the fair value gap. The market tapped the fair value gap 4 times. 4 times. Once over here. Second time over here. Third time over here. And fourth time right over here. This candle, I'm just gonna mark it out like this. Okay. Even though it wicked under, it still counts. As soon as it enters the fair value gap, it's considered a valid fair value gap. Okay? So there were 4 entries. It gave traders 4 opportunities to enter into the market. You would place your buy order here, target a 1 to 2 risk to a reward every single time. You're always going to target a 1 to 2 risk to a reward ratio every single time. What can we see happen here? What can we see happen here? This is a 1 to 2. As soon as price tapped in the fair value gap, it continued going up, making higher highs and higher lows. Eventually, it taps it in and breaks, hits TP exactly where it was meant to be, right? Now, you guys might call it luck because, how do you know? This you just placed it where it was and you're not really doing it live. Sure, but I took this trade and I sent it to one of my students. I took this trade exactly how it was. I sent it to him live the same day I took this. It's always going to be a 1 to 2. That's how the market works. At least. Not always, but at least. You're going to have to make a 1 to 2 profit. Risk to reward every single time. Alright? The times that the market doesn't go 1 to 2, it's always going to reverse and hit your stop loss every single time. It has to either hit 1 to 2 or go up further to 1 to 3, 1 to 4, 1 to 5, 1 to 6, or it doesn't hit any of your TPs whatsoever. 1 to 2 is the bare minimum. So I set it up 1 to 2, it hit. Now I didn't do it exactly up here. I did it I did it to where it said 2. It didn't say 2 point something because I don't like making it look fake, you know? It's so it's all authentic. It was legit a 1 to 2, and I just took this trade and I made $800 that night. It was simple, right? What did price then do next? Sure, price didn't hit the opposing liquidity, but it's relatively equal to this high over here. Even though there was this high, this is also considered a high. So this and this are both relative equal highs. These two are relative equal highs. They're relatively equal. It's just a few pips off. It's just a few ticks, few handles off. It's not much. Not a big deal at all. Right? Price stopped making higher highs and started making lower lows. Lower low, lower high, lower low, lower high, lower low. It broke under this market structure, making it a market structure shift. What did price then do right after? It formed a fair value gap. You see these candles over here? Now I'm going to show you guys how a bearish fair value gap looks like. A bearish fair value gap's same thing as the bullish. It's 3 consecutive candles. It doesn't have to be the same color. It's just the middle one has to be in the trend. So this is bearish, it's black, it's going down. It has to be the same color of the trend candle. So this is the bearish candle. These happened to both be black, which is going down. And you would mark out the bottom of the first closed candle to the top of the closed candle, or in this case, open of this candle's wick, and just drag it out. Just drag it out. As you can see, this gap got tapped in and shot straight down. You put your entry right here. Make sure it's a 1 to 2. And there we go. It's that simple, right? 1 to 2, boom. Take profit gets hit. Okay? We would never have known if price got down to here. We would never have known because it would have been a live trade. So no one can just predict the market like that. Not a lot of people can, especially not you guys can, right? So 1 to 2 is perfect, and you would have still made so much money simply in like 6 candles, 6 minutes. You're trading on the 1 minute time frame. Now tomorrow, or the next video I post, I will go over inverse fair value gaps, daily bias, and how to implement all of those in the ICT Judas Swing, the ICT Silver Bullet, and finally December is over, guys. December is almost over. It's mid-December. Once the holidays are done and the trading week, the holiday and the Christmas and New Year's is done, the trading weeks are back open on January 5th, around there. That's when the markets will start going back to normal. All right, you could start seeing more silver bullet setups. Excuse my stutter. Silver bullet setups, more Judas Swings setups, and those are going to give you higher win rates. I know for a fact, I've been losing December all month, like almost all month. I barely made money this month. I like almost broke even. I made like 1K in profit. I just lost all the other ones. So 1K in the month. This month was shit, completely shit. But anyways, this is exactly how you guys can understand. I hope you guys can understand now what liquidity means, market structure shift means, and fair value gap means. And yeah, that's basically all for the video. Thank you guys for watching, and see ya.